Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, November 16th, 5:08 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, bear market rally underway. You can see over here on the trend gauge, leaders holding up fine. Short term and medium term, all five of the major indexes are above their short term 21-day and medium term 50-day moving average. Long term continues to be a struggle. Small caps fell back below their 200-day today. As far as what happened today, a lot of red on the close, but all I see is a tight range day three of a consolidation. Basically, we pulled back to the high of Thursday's CPI induced gap up. We had follow through strength on Friday, consolidation on Monday, gapped up on Tuesday on PPI, but that gap up was it seemed exhaustive, and we broke back below the 4,000 level on the missile news in Poland, and today further consolidation. G6 value led today, especially large cap value. G6 down 2.3%, S&P 500 down 0.8%, NASDAQ 100 down 1.4%, Dow back in the leading role, losing the least, down 0.12%, mid caps down 1.5%, Russell down 1.9%, Global Diversified 60/40 down 0.23%, in-house GROTECTION down 0.78%. Let's get to an explanation of what we do here at Revere, and then we'll get into the index charts, other key charts, and then the focus list. So Revere is an SEC registered, fee-based only, fully transparent registered investment advisor. We are a fiduciary, which means we always act in the best interest of our clients. We have nothing to sell you except our services for managing portfolios. Our flagship portfolio is called GROTECTION. It's designed to grow assets during market uptrends and protect assets during market downtrends. We've been mostly in protection mode in 2022 since the markets topped in the first week of January. We manage individual client accounts using our trend following rules based on 3 time frames and how leaders are acting. Basically, the trend gauge that I showed on the prior screen. And in an ideal uptrending market, such as last October, November, will be fully allocated to the market. That's when we're trending above all 3 time frames, and they're configured according to small above medium, medium above long term. If the market starts to go sideways, our stops will take us out of the market. If we start to enter into a downtrend, the slopes of the lines of the medium and the short term will start to roll over. We'll kick up the defensiveness, and if we break below the black line, the 200-day moving average, that really gets us out of the way. And the reason for getting out of the way is these devastating losses that can occur if you are in a bear market. All of these losses, all 13 occurrences, take place below the 200-day moving average. The average high to low till you break the 200-day is about 12%. So the rest of this is what we're trying to defend against. The average of the worst of the 6 down 44.5%. There's a concept in investing called sequence of returns, and that is, what is the sequence that you're going to get out of the market from year to year? It's never consistent. It's wildly all over the place, and if you're getting close to retirement, you can't afford a severe drawdown that would destroy your nest egg. That's why our first job at Revere is risk management, downside protection, and the returns will come back when the market rights itself and leading stocks start working again, and we start climbing back above the moving averages, plus the added benefit of compounding your capital from a much higher asset base. It's much easier to compound if you're down 10% than if you're down 27.5%, which we were at the lows in October. So if you're interested in an approach like this, reach out to me. Email don@revereasset.com, or Revere President Dan Stewart. He's a CFA, king of all things financial. Dan@revereasset.com, or phone 855 Real Wealth. That's 855-732-5932. And speaking of different types of markets, we're in the process of transitioning since we had that follow-through day and the positive reversal off the bottom 2 CPI reports ago, from correction/bear into early recovery, to trying to maintain this bull market status where the expectation for our portfolio should be inline or minor outperformance. We'll underperform, as we clearly have. That's kind of part of the process when we go from bear to the early recovery. Early in a bull market, we'll start allocating our portfolios the way we are now, below the 200-day moving average. I mentioned this a couple videos ago, or maybe it was last night. We try to maintain the equivalent of about a 60-40 portfolio, or as at the maximum as much risk as the S&P 500, which would be called a beta of 1, is the same risk as the S&P 500. So we start ratcheting, getting back in. When we start do a shakeout below the lows, or as we start getting above these medium and the medium term and the short term moving averages. And right now, looking at the S&P 500, what we've been doing is 2 days up, three days consolidation. It's very clear on a 60-minute chart the importance of this 3950 level. Let's take a look at a 15-minute chart. I think that shows it quite clearly. Yeah, this is the one. So here's the gap up, 3.8% gap up. The only people that got all of this 3.8% gap up are the same people that sat through the 27% downturn, because if you have rules for selling stocks, you wouldn't have been 100% in the market with the situation that the market was in. But if you never sell, you would have been. So congrats to those people that got the full 3.8% on the gap up. But major congrats to the people who dodged the 27.5% in the first place. So it's very clear here. Gap up, follow through the next day. Inside day PPI, gap up. This is what the exhaustion was. Here's the move lower on the Poland missile crisis, 24 hours. We rebounded, we gapped down today, and very tight move. We're coiling for a move. Remember, the markets can only do one of three things: trend higher, trend lower, or consolidate, preparing for one of those trends. Very clear here, very strong support at this 3950 area, which was the low on the second day of strength and the high of the CPI gap up day. So any pullbacks have been contained to 3950. The title of tonight's video is "I like this day 3 consolidation. What will change my mind? A break below this 3950 will absolutely change my mind. A break below 3900 will have me kind of headed in the opposite direction." 3900, very clear here. You can see us trying to get back above it in late October, ran into 3900, failed, ran into 3900, failed, ran into it again, failed, ran into it again, failed, gap down, move around a little bit, chop, trying to go higher, going lower. Then the big CPI gap up here got us back above 3900, back above 3950 is where we closed, and then all the pullbacks. This is just a textbook picture of how resistance turns into support. And this 3900 to 3950 is a big level. We haven't visited it except for during most of the day last Thursday when we had the big gap up. So right now the market's saying, oh, okay, 3950, that's far enough. If they get down to 3900, that's the next level down, which corresponds to this late October resistance, which should flip to support. And if it doesn't, then we've got a problem and we're going lower, and we've got to reassess what's going on. So that's the story. Very key levels, very clear levels on the S&P 500. NASDAQ 100, kind of a similar situation, has been showing relative strength this week. Now, relative strength, what we want to ask ourselves is, if we're really looking at anything, what we had last Thursday and Friday was a combination of a shift from value to growth, and a big junk off the bottom rally, which is really just a fancy way of saying short covering. People that were betting on the market going lower saying, ooh, looks like we're not going lower with this big gap up anymore, and that pushes these beaten down stocks higher. So really what we want to compare is where the price of anything is relative to Friday's high. Or Thursday's high. That's going on with the S&P 500. So where's the NASDAQ 100 relative to that? Still above Thursday's high. So Thursday's high, pretty critical for the NASDAQ 100. That is 282.75. Let's go to the Dow Jones Industrial Average. Now you're going to see that the Dow is below Thursday's high, but this is just really a transition process for the Dow. It's really just been consolidating for all 5 days, you could argue, but that's because it had a big leadership characteristic going into the flip from value to growth, which is what took place last Thursday with the big move up. So staying under this 34,000 level, just kind of going sideways for a while, relative weakness, but not that big a deal. Note a day like today, it showed relative strength when some profits were taken on growth and rolled into the things like staples, utilities, and healthcare. Let's go to mid caps, MDY. Staying above the 200-day moving average, just about even with the close from Friday. I keep saying Friday, it's Thursday. Thursday was the CPI gap up day. And really just going sideways, letting the shorter term moving averages catch up. The ADMA is approaching these lows of the last 3-day consolidation. The 21 still quite a ways away, but we want to stay above this 200-day. We're well above it on the Dow. Let's see what the percentage is. 3.2% above it on the Dow. Mid caps hanging above, not near as much, but 1.4%. Now, small caps have been the laggard today, and they actually were the laggard on Monday. Also broke back below the 200-day and below the Thursday close. So relative weakness on small caps, but just pulled back to their ADMA. This is where, if the trend is going to continue higher, it should hold at the ADMA, get back above the 200, and we'll see what tomorrow brings. Let's look at the even weighted indexes for the S&P 500. Here's the RSP. This had been hanging above the 200-day moving average, closed back below it today. So even weight S&P outperforming the tech-heavy regular market cap weighted S&P, closed below it, but still basically right about at Friday's or Thursday's close on RSP. And the NASDAQ QQEW, equal weighted NASDAQ, outperforming. QQEW outperforming the NASDAQ 100. You can see it's well above Thursday's close and showing a lot of relative strength over the past week. A little dip down today, but well above the lows of Friday too, which is where most of the indexes are hanging out, although it did fail into the 200-day, but the equal weighted NASDAQ 100 didn't get anywhere near the 200-day moving average. On the peak, which was yesterday, it got within about 6% of the 200-day moving average. So again, you can see how those big FANG type stocks are just a boat anchor around the NASDAQ 100 and really pulling down the S&P 500 too, which has allowed mid caps, small caps, and the Dow to outperform. Let's go to the VIX today. Markets were down. You might expect the VIX to be up. It was not. The VIX down 1.43%, below all the moving averages, hanging right at that 24 level. We'd like to see it break back below 24, which should juice the market a bit to the upside. What did gold do today? Well, before you ask what gold did today, you want to normally ask what UUP did. Gold with a little bit of a pullback after 4 straight up days, including some nice gaps here, big gap up on gold. on CPI day on Thursday, 4 straight days. So gold outperforming the indexes. What did the dollar do? Dollar was down today, but again, it's consolidating. We want to see the dollar break below yesterday's low. That should give a boost to stocks also. 28.52. I'm fighting a cold, excuse me. 28.52 is yesterday's low on the dollar. Bitcoin still struggling. Another exchange said they're going to have to file for bankruptcy. Just really consolidating now on Bitcoin. Let's look at the 30-minute. Here's the gap down on FTX. 1 day of a reprieve. Another gap down here, trading in a tight range. Bitcoin really, it's the granddaddy of them all, and head and shoulders above all the garbage that has been put out there with absolutely no utility or purpose. I mean, for crying out loud, they created Dogecoin as a joke, and people buy it. So talk about no utility. TLT, change in character, getting above the 50-day moving average. This means that long-term rates are pulling back. Let's look at the TYX. Breaking below the 50-day moving average. Big change in character in interest rates, really pulling back since we had that 11/10 CPI report. Bonds were closed on 11/11, a little bit of a reprieve, but first time from an intermediate term trend standpoint that we were below, going all the way back to August. That's normally good for stocks. It really wasn't today. However, let's look at the 10-year. Still above, nope, second close below the 50-day moving average. And the 21 clearly rolled over now. We're getting into oversold range on the 10-year notes. Showed the dollar. What did junk bonds do today? Inside day, down a little bit. Basically kind of consolidating the same way that the overall indexes are. So those are the major indexes that we want to take a look at. And let's take a look now at the tail of the tape. The stochastics indexes still okay. G6, some of them are rolling over. Got to keep an eye on that as growth has underperformed. Growth underperformed today, putting that little bit of a hook in. The NASI RSI is still fine. The dollar, since we broke that 21 in that island day, that's bullish for stocks. TNX and TYX not only below the 21 day, but also below the 50 day. Now, sentiment. I talked about how the put call was alarmingly low yesterday. It was high today, which is good. You want to see some fear in the market, 1.22. But that fear wasn't confirmed with the VIX as it dropped 1.75% today. Fear and greed down a little bit to 65. Some news. San Francisco Fed President Daly this morning interviewed on CNBC. She said she sees consumers stepping back, but also is not, for her, pausing is not on the table. She sees rates going up to 5% before considering a hold, and that certainly didn't help stocks this morning. That I believe contributed to the gap down. Day count up 2, followed by 3 days of consolidation, coiling for a move. Semiconductors hit hard today by Micron. Micron said we're cutting our memory chip production for fourth quarter by 20%. And Micron, the SOX, for whatever reason, takes a big cue from Micron, and memory chips have nothing to do with a bunch of these other semiconductors. But the SOX was down today by 4.1%, and it's kind of a baby out with the bathwater. After hours, NVIDIA up a little bit on its earnings report. Let's see if that can light a fire under semiconductors. Expectations still positive as long as we're above 3,900. Value outperformed growth today, which was, again, day 3 of the consolidation. This key 3,950 area held on the S&P, but we broke below this 286.82 fib, closing at 285.44. Need to get back above that. Really tight base all day today. I said 3 hours and I didn't finish this, but nothing significant coming out of the action intraday. It was just a tight consolidation day. Bonds higher, XLP, XLU higher, XLV down just a bit, but showing relative strength. On the downside, oil's pretty much weak all day today. Retail weak after Target pretty much said, yeah, it looks like Walmart's management team is better than ours. Walmart having the complete opposite reaction of what Target did today, down 13% on its earnings report. And that hit retail across the board. I mentioned semiconductors because of MU and IGV as tech took a hit. All these focus stocks, we'll take a look. GFS, we added to that today on a pullback. It's hard to do. That's really what you need to be doing. And it reinforced my decision not to add to GFS when it broke out yesterday. And then we bought back into SPXL. We exited this on that break below 4,007. That failed move above that key fib earlier this week. We bought back in a little bit below where we sold. So a little bit of relative strength there on the rebuy. But the bottom line, very tight action, day 3 of a consolidation. Charts are okay. Not seeing much damage, but very clearly we're coiling for a bigger move because, I mean, that's just what markets do. They coil and they trend, they coil and they trend. And if we're going to continue the trend, consolidation should resolve in the direction of the primary trend. In this case, the primary short-term trend is higher after the CPI gap up last Thursday and followed through strength on Friday, and then the 3 days of consolidation. So let's take a look now at our focus list. GFS broke out today. You know, post-trade review is so important, and seeing that buying a lot of the things after strength and then having them show normal pullbacks and us getting stopped out, that's what kept me from adding to this yesterday on the breakout, despite the big volume days screaming at me, say, buy me, buy me. But look, I love this. Volume 19% below average today, pulled back with the rest of the semiconductors on Micron news. Micron and Global Foundries have absolutely nothing to do with each other. All it did was bounce off the ADMA and close mid-range, so we added to our position today. Next up, SHLS. Almost bought this today, but with the markets being weak, I didn't. Showed some relative strength today, up, closed right at the pivot today, still very high on my list. Celsius, strong day today in the face of a weak market with a close back above the century mark and above the high of the earnings day. You know that for me, inflection point days, the highs and the lows are very critical. This is acting very well. I would have liked to see more strength, more volume today, but good enough on the volume patterns. The down day was on lighter volume than 3 of the 4 prior up days were, and this climbs its way up my watch list for sure. AEHR, I saw a lot of people not happy with this today, and it's another reason why you got to take profits into strength in this market. We're under the 200-day moving average. AEHR down 12%. Really, that's only a 1.5% of its ATR move down. You can't be okay with it being up 13% one day, up another 5% the next day, 2 more days higher, and then it gives it all back in 12%. You can't complain about that because the stock is extremely volatile. That's what it does. All it really did was pull back to the top of this kind of consolidation area. And if it shows any strength, like getting back above the ADMA, it might be something that I'd take a shot at. And the volume was barely above average, 9% above average. So they say, what's the difference between a correction and a pullback? It's a correction if you own it. It's a pullback if you don't. So I don't own it, so it pulled back today. We got stopped out lower. That's just part of the system. ON, another one, arguably a baby with the bathwater, down 5.4% today. Micron has absolutely nothing to do with ON, but all semis were weak today. Boeing still liking this. It continues its consolidation, even tighter range on even lower volumes, 47% below average volume today. Looking good. Boeing, Home Depot. This looks great. Good reaction to earnings, good reaction to the gap up, and really just consolidating this move up. You can see we've got some alerts here above 317. I'll be looking hard at it. This is another one when you're buying big stocks like this, you got to make sure that they are capable of outperforming the S&P 500. And when it's being accumulated, Home Depot fits that bill. Lowe's, good reaction to earnings today, ended up 3%. Closed near the bottom of the range on a weak market day. Basically, it ran into this 220 resistance area from back in August. So this is another one that has my attention now. UTHR, a biotech, acting pretty well, consolidating this big move up on earnings. You're seeing a lot of this 2-3 weeks tight after a move up on earnings, but at some point, these things are going to have to resolve higher or break down. Pure Storage, another one that got hit today on Micron, gap down 3.42%. So right now, a failed breakout right at the 7 to 8% loss area. Uber, Alex on our morning call informing us that cab fares in New York are going up by 20%. Well, Uber's going to benefit from rising transport fares in big cities. Note the 3 big volume up days over the last 4. The big move up on volume on earnings. Pullback was kind of harsh, but on lighter volume. It did violate the low of the gap up day. That's not a plus, but quickly reclaimed it. And you see the cup and handle being recognized here back above the 200-day moving average. Melly, this was brought up in our morning call also, back above 100, does have overhead supply going back to March or April, but that's a pretty tight base, still has very strong fundamentals, battling with that 1,000 level. Shift for payments. Visa's numbers prove that the American consumer is still spending. This had a move to the upside 6 straight days after earnings. Tried to break out. You can't buy something on 6-day up. Now today, DLO, another payment stock, a short seller came on CNBC and mercilessly slammed it. It's down 51% despite reporting earnings 2 weeks ago. I didn't really get the whole story because I wasn't really interested in the stock, but it looks like it drug 4 down along with it, down 7.5%. But that's a big number, but in context of the 6-day move, it's really not significant. Last 2 here, InMode, INMD, very tight, back above the 200-day moving average. This was a big former leader, now more reasonably priced with a reasonable PE. Cup and handle broke out, was violated. But good volume coming in 2 of the last 4 days, and finally CEG, which has been on the 21-21 list for a while, still acting well, holding the 21. That's going to wrap it. As always, love to hear from you, good, bad, or indifferent, with feedback. Don at revereasset.com. The phone is 855-REAL-WEALTH, 855-732-5932. Remember, I say it at the end of every video and podcast, it's not how much you make in the market, it's how much you keep. We've got our beta at up to 0.77. We want to keep between 0.6 and 1 as long as the market's holding up and we stay above the 50 and the 21-day moving averages. And then we break back above the 200, we'll get it above 1, but that's where we stand right now. So wrapping up Wednesday, 11/16. Don Vandenbord telling it like it is. Thanks for listening and have a great day.